Why did I sour on Starbucks, the famous coffee company? And can it rebound and regain its former glory? I answer all of that and more in this video. Welcome to the Food Fund. There is a lot to unpack here, but let's start with the price action. Over the last year, you're looking at a -6% CAGR. Zoom out to 5 years, and it is barely a 1% CAGR. The company has gone nowhere in half a decade. Market share is a huge factor for food and restaurant companies. The dashboard shows Starbucks is the largest restaurant company, but it is barely expanding its market share. Looking closer, they have a whopping 4.45% share of the market among public food, beverage, and restaurant stocks. Over the last 5 years, Starbucks' market share has actually compounded at a 3% CAGR. They've gone from 3.99% in 2021 to 4.45% today. The market share gain is slow but steady. Let's look at the fundamentals for more. Gross margin is 24%. This isn't great, but it is not bad either. Revenue has grown at a 6% CAGR over the past 5 years, now at $36.7 billion. While Starbucks is not perfect, generating $36.7 billion every year gives management a lot of leeway. Cash flow is where the trouble starts. Operating cash flow decreased at a 5% CAGR, CapEx worsened at a 17% CAGR. The result, free cash flow has fallen at a 17% CAGR. Despite generating ever-increasing amounts of revenue, Starbucks continues to spend more and more, both in operating costs and CapEx. Weighted average shares outstanding have decreased over time, going from 1.19 billion shares in 2021 to 1.14 billion shares most recently. Starbucks has done a good job buying back shares. This is a great use of their free cash flow. Next, return on invested capital. This tells us how efficiently management has used capital from investors. Going from 13.7% in 2021 to 8.8% most recently, management has clearly done a poor job. Starbucks has generated worsening returns from its investments. For operational efficiency, measured by the cash conversion cycle, Starbucks is doing slightly better. Cash conversion cycle went from 20 days to 15 days. Management is slowly improving the efficiency here, but I really want to see this value be negative. Finally, debt. Net debt to EBITDA has risen from 2.5 to 3.5 most recently. Starbucks is carrying an increasingly larger debt load while generating less earnings. This is a horrible combination. Now, let's compare Starbucks' performance against the gold standard, the S&P 500. Investing $10,000 in Starbucks would have grown the investment to $17,958 compared to $37,146 in the S&P 500. That's an annualized return of 6.2% for Starbucks versus 14.5% for the S&P 500. Starbucks also showed higher volatility than the S&P 500. Risk-adjusted returns, as measured by the Sharpe and Sortino ratios, were worse for Starbucks. Investors were better off owning the S&P 500 instead of Starbucks over the last decade. Starbucks was founded in 1971 in Seattle, Washington. Shifting from selling coffee beans to running beautiful coffee houses, global expansion, largely driven by Howard Schultz, was undertaken. Today, Starbucks offers a wide variety of handcrafted beverages, including fresh brewed coffee, espresso drinks, frappuccino blended beverages, teas, and pastries. The company has over 360,000 employees and remains headquartered in Seattle. Despite its size and legacy, Starbucks has a lot of issues. Based on my proprietary scoring system, I give Starbucks a 1 out of 10. Let's dig into why Starbucks continues to struggle in an industry they used to dominate. Before I share my final thoughts on that, if this analysis was helpful, please hit that like button to let YouTube know. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on Starbucks. Let's write it out in the spreadsheet. It is a restaurant company with a gross margin of 24%. The 5-year revenue per share CAGR is 8%, and the 5-year free cash flow per share CAGR is -16%. Though the margin and revenue growth are decent, free cash flow is taking a big hit. A return on invested capital of 9% is low and is worsening. Next, the cash conversion cycle of 15 days is high, but seems to be getting better very slowly. A net debt to EBITDA of 3.5 means that it would take Starbucks around 3.5 years of earnings to pay down their debt. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 88.7, indicating that Starbucks is extremely overvalued relative to its expected earnings. As a customer, I like Starbucks, but as a shareholder, I couldn't get over how great a position the company has squandered. If we calculate the market share among just restaurant stocks, Starbucks holds a 23% share of the market. Think about that. Nearly a quarter of all restaurant spend to publicly traded restaurants goes to Starbucks. Starbucks is a very important player in the restaurant industry. Here we can see one reason why Starbucks has been performing so poorly. They are ceding market share on the order of about 1% per year to competing restaurants. Additionally, the rising expenses and debt indicate a tough future for shareholders, and the trend of declining same-store sales was becoming worrisome. I sold Starbucks for a double-digit % gain because of opportunity costs. The company has a lot of work to do before they can unlock the potential I think the company has. Former Chipotle CEO and now current Starbucks CEO Brian Niccol shares more on what is slowing the turnaround.
When I got here about 10 months ago, we said we were going to get going on this back to Starbucks strategy, which really is founded first and foremost on resetting our operating platform. Unfortunately, I think there were some choices made before me that really set us back on our ability to create that great customer connection between our barista and customer and provide the type of customer service that the Starbucks brand, frankly, is known for and should be known for. And so that's really why we created the Green Apron service model. It's all around basically providing the right labor in store so that our partners have the right amount of time to execute the tasks that they need to execute, and then also be able to give the customer service and that connection to our customers that we want to provide.
The turnaround is taking longer than anticipated. They need to cut costs aggressively while maintaining quality. It is not an easy task, and they don't seem to be making headway. Furthermore, there are other restaurant companies that are doing a much better job in terms of execution, and I'd rather allocate my capital there. I like Starbucks and would restart a position when the fundamentals improve and the price to opportunity cost becomes more favorable. Hopefully that will be sooner than later. What do you think about Starbucks? Are you an investor? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now and remember to put your money where your mouth is.